Welcome to the AHQ online meeting where we highlight specific subject matter experts that are extremely knowledgeable in the area of mergers and acquisitions, investing, as well as seasoned operators that are sharing tricks and specific information that would really help you out there with your business or your investments, or as well, like today, to build an investable business. It will be taught by John Curtin. He's an investment banker, has many, many years, 15 plus years of experience in the space, is an entrepreneur as well. So he speaks the language, and we're going to be highlighting some of his knowledge. But before we do, we want to speak a little bit about the actual organization of the acquisition headquarters and where we're heading, as well as where we've been. Goal for today is to establish purpose and value, of course, of AHQ. Learn to build an investable business with John Curtin, best practices for your exit value of your company. Some of the factors that play a factor in the increased valuation of your company, and we'll learn that here soon. So who are we? The acquisition headquarters is a premier hub for business owners, investors, and service providers wanting to build relationships through M&A, increase their understanding of strategy to be able to increase, again, their value of their business. And we have both in-person education as well as online experiences, as well as education as well. Some of the problems that we noticed and that we wanted to solve were the lack of education to increase understanding during transactions to increase your overall valuation, a lack of access to resources, both in the middle market as well as the understanding of multiple arbitrage, as well as acquiring companies with the company that you have to be able to increase and grow, building trusted teams and executing on deals efficiently and effectively, which is what our ecosystem truly solves. We've got quite a bit of current traction. This year of 2025, we launched our September 3rd successful national conference. We'd had over 225 people that showed up. We've got now a total of roughly 90 members across a multitude of states in the US. And we completed our fall tour in Salt Lake City on November 17th. We then launched AquaCon 2026, which is going to be hosted on March 5th and 6th in Salt Lake City. We're excited about that. And we are also launching our acquisition headquarters councils in January. The two cities that we've chosen to launch in January will be Salt Lake City and San Diego. And we were excited about this number because our 2026 recap was we hosted 22 events in 15 different cities and 2 national conferences. So there's been quite a bit of traction that is creating massive momentum leading into 2026. This is just a few pictures of our fall tour that we experienced. This was our fun fall tour in Denver, Colorado. This is another one we hosted in San Diego, beautiful San Diego. And this was our final event of the tour. Lots of happy faces, great networking. And where we're heading, again, we've got our national conference coming soon, March 5th and 6th. You can get your ticket at aquacon.live to be in the room with other people just like John here on the call. Our acquisition headquarter councils will be, again, releasing on January 23rd, which is going to be Salt Lake City. And then we've got San Diego, again, our city launch, which aggregates capital providers, seasoned operators, and M&A experts, all to create a healthy ecosystem and dynamic relationships for you. Moving on, we've got John Curtin here. He's the founder of the Harbor Stone Group. He's an investment banker. He's been doing this again for many years. He's had 3 successful exits, 6-time founder, and he truly is an expert in maximizing your valuation and understanding how to close high-end value deals. I just want to say thank you so much, John, for joining us today on this broadcast, and I look forward to learning from you now.
Yeah, absolutely. And it's great to be back with the Acquisition Network. We started quite a bit ago, and there's been a lot of good events. So we also are very, very focused on the education piece of selling your business. We've seen so many times that essentially investment banks say, no, we'll tell you where to sign on the dotted line. Just give it up front, we'll run it, and then you sign here. And there's a lot of misunderstandings. And a lot of misunderstandings way before you do a deal of what's valuable. So I want to kick off here for this presentation, talk about the two very simple things that are the entire heart of preparing a company for sale and then getting the highest price. And it falls into two buckets: how you communicate your growth potential by adding capital, growing organically within the things you already do, and who you'd acquire. So this growth piece is really you helping us to put a map together for a buyer to say, you could easily triple this over 5 years doing all of these tasks. And then number two is really heavily on the investment banker to document everything and do all of the sell side diligence so that we lower the perception of risk in the company so much that we can get to the last dollar. They believe our accounting, they believe the legal situation, they believe our commercial diligence, and ultimately now they believe, number one, the owners being able to show them the path they would go if they had more money. So this is important because like Nathan has mentioned, I have started 3 of my own companies and sold them. In the first case, I was right out of college, built a company for about 2 years and sold it. And let alone really building out the communication on growth and being able to lower perceived risk, we were just happy that someone was talking to us, right? And a lot of business owners are in that position and are getting unsolicited offers. And the odds that that offer is the highest you could get, even if for that buyer it's the highest they've ever paid, the odds are very low that that person who came in off the street is the highest valuation. And they probably wouldn't be soliciting you if they weren't trying to get a deal. When we go to market and we prep the company and we talk about the following things I'm about to jump into, you can hyper maximize the value of business and create a bidding of, in many cases, we've gotten 70 to 100 different funds, companies, and individuals bidding on a company. So as we go through the presentation, you will notice that everything falls into one of these two buckets. I'm going to very quickly set the stage here. I'm not going to get bogged down, but I'm going to talk about valuation, right? So as you can see, number of valuation metrics. If you look to that one at the top, we are using an EBITDA multiple, averaging out some of these others, but it's essentially an EBITDA multiple. Earnings before interest, taxes, depreciation, and amortization. We try to put apples to apples. Companies that have different debt levels, different tax areas, asset heavy, asset light, we're kind of eliminating that effect. And we're saying, oh, Mr. Business Owner, you could get 86 million to 156 million. That's a big range. The difference between getting 86 million in this case and 156 million is the 7 things that I'm going to present for you to slide from somewhat high risk, but sellable, to I have no doubt in my mind that the company is running well and I'm able to, as a buyer, put $1 in and get $1.20 out every year, at least, right? This is the conversation that I'm setting up. Lastly, let's say you get that EBITDA, adjusted EBITDA, you get a great multiple and your enterprise value is that $100 million. Do you get all $100 million? No. While this is not the topic of this conversation, that second line there, enterprise value, debt and liabilities, working capital, excess cash, That is known as cash-free, debt-free. If you want to talk more about that, that is a huge piece that you need to know that backward and forward. You need to understand how much cash am I actually going to get in a transaction, and it's at the in your books. So please reach out to us if you want to dig into that and really understand how that's going to affect you. Without any more to do, I will get back into the 7 high-level things that you need to build an investable business and that make it so that you can sell that business for the absolute highest value. You will notice that in the same way that every one of these things is talking about moving from the bottom of the valuation bar to the top of the valuation bar, some of these things, if you don't have them, you're not sellable. And one of these things, if you change your revenue type, your customer churn rate, and your recurring revenue type, you can move the entire bar up. So that is one of the most important pieces as we quickly run through this. Number 1 and 2, who is your CEO and can your company run without you? The CEO is the operator. If you want to be able to sell your business, you have to be in the position of an owner, separate from the company, because a captain has to go with the ship, right? If you don't want to sell and keep working for your own business, you need a CEO in place, you need a team in place. We talk a lot about some of the how to do that. You can see some of these slides. And while it's not the conversation for today, unbelievable groups like EOS, business advisors, when you talk about primarily how can I get myself out of the day-to-day as an owner, watching the trains go rather than making sure they're going out on time, right? That is something you could engage an advisor and really work on. And not only replacing your role, but making sure you have duplication in every role and making sure that if you take the 1-month vacation to the positive or you get hit by a bus, that the company continues to run without you, automatically generating revenue. I want to jump into the most important valuation change. Almost nobody understands how much power this lever has. There are some cases where 2 companies, exact same revenue, exact same net income / EBITDA, in occasionally the same business, and one has, say, new jobs every time. They have no contracts. The other maybe even does some initial discounts, but locks people into a 1, 2, 3, 5-year contract. The difference between those 2 can be double or sometimes triple the value. Blows people's mind. So while you're probably not going to go from completely a one-time revenue all the way to a we are contracted revenue, there is space in between these 2 extremes. If you act as a lemonade stand today and you're competing on pricing, which is my least favorite term, competitive pricing, and you can't go to the point where you're a black hole like a Salesforce, Netflix, 5-year government contracts, right? You're an app that nobody cancels. That space in between, if you can even go from high customer churn lemonade stand 20% closer. We've advised commercial roofing companies who obviously they want to fix your roof and that's the end of their job. If they do a good job, they don't have to come back very often. But they were not pushing maintenance contracts. They were not pushing warranties, things like that. And by pushing maintenance contracts, even though it seemed like a very small percentage of their actual revenue, that was valued at a significantly higher multiple and ultimately allowed them to get back in and solve roof problems without allowing competitors in. So just finding any way to improve the churn. Churn is a kind of SaaS metric that's the percentage of people that leave you over the course of 1 year, right? If you have recurring revenue and you continue to do a good job, you can look back over 5 years and say, I got an average of 5% churn of customers over the last 5 years. And that would be the gold standard. If you're at 60% churn, I get it. Is very similar. We're just trying to find ways to lower that churn rate to expand the amount of time that we work with clients. We're getting into some of the automation and professionalization. That's really the topic of this presentation. From the side of AHQ, right? We really talk a lot about professionalization and understanding your business, and again, making it run without you. And this is the how-to, right? Good employee retention rates are not as simple as making sure employees are happy, have a beer pong table. None of those things have really worked, right? But employee retention is so much more important than many people may know, because when you're buying a company, you are buying essentially three things. You're buying the customers, you're buying the people and the processes they use to run, and you're buying that IP, which could even be how you train your people, how you do the process. And if you're alive a couple of years after starting, you are the 1% of 1% of businesses that actually survive. And your employees and your IP have massive value that most business owners don't recognize. So how do we keep employees? Again, a subject with your advisor, but we have always put forward that creating a learning culture, making it transparent how the employee can go from where they are today to kind of their ultimate goal, and being able to give them opportunities to feel like they learned, grew, will retain people more than anything else, and doesn't require you to constantly give them a bonus just to keep them. So work with your advisor on that. Make sure not only is the company running independent of you and you have essentially automated revenue, it's recurring, customers don't leave. You're making sure that your employees don't leave. They don't take the knowledge with them, and they are staying and valued. And ultimately, that you prepare them in the case if you were to ever sell over many years, so you're not spooking them at the end, by giving them some framework, whether that's their guarantee to stay bonus, whether they have some kind of phantom equity at the top executives for if a sale ever happens. You really need that company core to be strong so you can hand it over at sale. I work with all over the country, and this is our favorite thing to do, breaking into groups of three and identifying more recurring revenue and how to reduce client churn.
Looks like we lost John. We're going to be patient here and allow for him to get back on. In the meantime, I'm going to share with you guys just a little bit about what we've got going on within our network, which we believe is extremely powerful and very valuable for those out there who are wanting to connect with others that are extremely wise in their ability to understand how to create value within your companies, how to invest, and as well be able to collapse time, because that's in essence what we've created within the acquisition headquarters. So right over here, we've got ways that you can continue to access others. And some of those ways are one through our web app and the community that we've created. And on that web app, you've got multiple ways that you can connect with each other via social threads in the different councils and cities about various topics around M&A, investing, and also deal validation. Then you've got the ability to have curated introductions from our community manager that gets to know you and everything that you're working towards. Also, you do have significant amount of you do have a significant amount of access to all of our council meetings. So before we get into that, I'm gonna go right back here. Looks like John is coming right back in, and we'll get back to the show. Hey, John, thanks a lot for joining us again.
Hey, yeah, that was a forced intermission. Hopefully everyone got popcorn.
Hey, not a problem. Well, thank you so much, and we'll just hop right back into it. Thanks a lot.
Awesome. All right, pop us back up here. We talked a little bit about employee retention rates, how valuable that is. I kind of call it the three legs of the stool: customers, employees, and IP, right? Let's say you have a great business, you're independent of the business, you have customers that are staying many years, and you have guaranteed payments, and you know when those payments are coming in. You've hit all of these things. You have great employees, they're very happy, they're growing. The next question becomes, well, fantastic, you have all this really solid revenue. Well, what about your customer concentration? And there's a lot of concerns around that because if you have one major customer and you lose them, they lose budget, something happens to them, the customers they've bought, one third of that equation on the three legs of the stool, has disappeared. So, very quickly, there's a lot of definitions of it, but if you have 25% or more of your revenue, one customer, or 50% or more in the top 10 customers, you have a concentration problem. How is this solved? It's really about the professionalization of the organization that we talk about constantly in the acquisition networks, right? Being able to have the company independent of you, the sales not dependent on you, and building an activity-based sales team. Which again, while not the exact topic of this presentation, that is something you want to go to your advisor with and say, I need to build an activity-based sales team. I need leading metrics to know if my salespeople are doing all the right activities, and I need to create auto-generating sales leads. I can't be the only salesperson, and the only way I'm going to get out of this concentration issue is to sell my way out, because nobody wants to drop their biggest customer to solve it. We want to bring all of the other customers up, right? This is a major step in a business. When I'm on, say, the buy side, I'm helping someone acquire a company. When someone says we get all of our sales by word of mouth, that's kind of the magic word that makes my ears ring, right? That means this company is so good at servicing their clients that they're getting all of their sales from word of mouth and they're surviving. And the question pops into my mind, what if you tried to drive more sales, right? It really is that easy as a buyer. I know this company is very solid. They've done no advertising, they've done no outreach, no sales. And now I'm going to come in and I'm going to create an activity based sales team and I'm going to professionalize this organization. Generally, if you're the seller in that scenario, you get discounted quite a bit for having concentration in customers. But I have this massive opportunity that if I know how to build an activity based sales team, that I can buy that from you at a discount and then have a huge return by using that information. If you are going to speak to an advisor or you really are intent about building a super high value company, some of the things you really need to focus on is how do I get my business independent of me and how do I build an activity based sales team? You need to not be making all of the day to day decisions. You need to not be dealing with employees and HR every single day. And you really cannot be the only salesperson or even a large percentage of the sales. This is the number one area that we recommend someone go out and solve. In the technical trades, we have lots of people who get offended when we say this. But in most cases, successful businesses are sales companies that happen to do something else, right? You're an accounting firm, you're a sales company that happens to do accounting, you're a you're a lumber business, right? But really you're a sales organization that happens to do lumber. It is all about being able to create an activity-based sales team independent of you because as business owners, if we're involved in the operating piece and that's what we're very passionate about, that's not going to be the problem, right? If you're focused on making sure that quality is there, your organization should primarily be a sales organization that happens to do the thing that you really love and specialize in. I won't hit that any harder, but if it's time to professionalize, the things we're going to get into now are financials, right? Measurement, being able to make a company a full-on world-class business that if someone added money, they will get more money out immediately. But this is the major piece for growth. You may even, as you're building this, incentivize some of those salespeople to sell the recurring type revenue, contractual revenue, or longer running revenue that we talked about previously. Now that you know, all revenue is not equal. To be able to sell a business, we talked about you have to lower the perception of risk, right? Nothing does that better than them coming in and being able to believe the financials. They look at the quality of earnings on your sell side that you've done and say their quality of earnings CPA comes in, essentially checks through the work and moves on, right? Maybe tests a few things. That is best case scenario. They believe your financials, we move right along. You have a legal diligence, all the legal risks, all the way the contracts work, they move right on. And now we talk commercial diligence, the greater industry, and you get to sell these buyers on how great it would be to own this company and all those opportunities out there that if you had a big bank account, you could take advantage of. We were on literally earlier today with a company that works in the ag industry. And they went from making $3 million EBITDA one year to the next year 7. And we said, what happened? And they said, well, that was just we were able to take advantage of a number of the customers that we were never able to service before because we had a really good cash flow year. And it's like, how long have you been missing out on those customers? They said 2022. In those scenarios, if you sell to somebody that has the money, They could have literally had 7 million, 10 million EBITDA every single year, and they were stuck at 3 because their capacity, right? We need to get everything totally tightened up and to where we can show you add money, I push out profit. And it's worth mentioning that most deals, in fact, almost no deals that we run, it's a very small percentage, and maybe we had a couple, are an actual full exit. Generally, if you want the most money, you've prepared the company, you've professionalized it, and you sell 65 to 80% of the company, and you're at least advising if you have in there, and you're setting them up to succeed, right? So as we get into this professionalization, I want to be thinking about, I'm not selling the business, handing it away. I need a machine that if it tripled, it would still work. And we'll talk a little bit more about that. Can you close your books within 15 days? I really say 10, right? How much time is your team wasting on manual entry? Do you have an ERP system? Are you over, say, $20-25 million and you're still books? There may be some issues. You're going to have to do a lot of workarounds, right? To be able to close, have KPIs. We're making sure that everyone in the accounting department sits in the right seat. If you've grown to a certain size, CFO is not a controller. Controller is looking backwards, making sure it's accurate, very important for diligence. But ultimately, you have nobody looking out and leading financially the organization. You are probably the CFO if you do not have one. This second line, the business is structured as an investment grade company. This is huge. I can produce financials and directionally write information. If somebody is running their business and they don't know what their financials were until the end of the month after the close period, it is not very useful. I need directionally accurate information so I can make time relevant decisions and react to issues. If you don't have that, I just checked another box of risk as your buyer. I need to fix that. I'm going to have to go implement a process. The math around a buyer, especially if you're talking about private equity, is that they usually buy a company and hold it for 5 years and resell it. If they have to pause and they have to fix your accounting process, they have to build an activity-based sales team, and they have to create training, right? They might be wasting a year of their 5-year hold period. And so they're not capable of paying you all of the money you deserve. Financials are more important than you would think. Also, what seats they sit in. We talked a little bit about staff accountants and controllers. Looking back, if you don't have a CFO, you are the CFO. You need to look out. If you're going into a sale process, hiring a fractional CFO, if you can't hire a full-time CFO, it's going to be absolutely necessary. It's going to be a full-time job for your team to sell the business, and you have to continue running the business and beating numbers. I, as a full-time accountant, use the phrase exit Excel hell. When you get to a certain size, you can't be doing all your reports in Excel. You're going to need a business information system. You're going to need KPIs that everyone can see at once. You have to professionalize. You have to create a company that runs on its own and you're able to see easily. You need to have all of these KPIs. People talk to me about tech stack. That's another big conversation in our acquisition network and in the acquisition HQ, right? I have created training for my employees. We have best-in-class processes. We have really good customer onboarding, but do your employees all know the KPIs? Heck, do you know the KPIs? What your sales revenue is, margin on every slight slice of revenue? What is your cost of customer acquisition, right? New hire ramp period. How long does it take for a salesperson to get profitable when you bring them on. If I don't know that, I'm throwing darts at a whole bunch of salespeople and wondering why am I losing money in 3 months? Well, the new hire ramp period is 6 months, so I need 6 months of cash, right? All of these things, if you don't know any of these and more, the buyer goes, they don't know their business well enough. I'm going to have to implement a lot of professionalization. So while you want to be independent of your business, there's actually a lot of work to do when you're independent of your business. When you're not running the day to day, there's still a lot of things you want to measure and know about. As you're building your tech stack down that left-hand side, if you can build a tech stack that all clicks together, you can avoid a huge expense there in the middle data warehouse. But if not, and you have disparate systems, it is going to need to flow into a data warehouse and into a business information system, right? Save yourself a few $100,000 if you're starting now and get a system that all clicks together, your CRM, your ERP, and is capable of growing to multiples of what your business is now. Again, if your business isn't professionalized and they have to implement a new CRM and ERP, they have dead time where they could be growing the business, but they're not. And so they are discounting you based on that lost time. Knowing your trends, knowing where your customers are, these are all very simple things. Here's one very, very important in especially construction, where you have 5-7% net margins on a job, and all of the general managers, right, decided around Christmas they wanted to buy extra presents, so they started doing all the overtime, sending everyone back home, and you don't find out for 2 weeks. On a 5% net margin construction job, that's going to be a major issue. I need to know about that basically every day. Managing that, seeing those time clock KPIs, understanding where the business is. So in summary, how do you get into your business? Who's your CEO? Is it you? Are you going to go with the company after sale, or have you brought one in? Can the company run independently with you? Day-to-day decisions, can every department function? And related to, do you have diverse customer concentration because the sales department runs without you? Are you focused on customer churn rate, your customer experience, and making sure you increase the amount of times you work with customers, making sure the least number of customers leave? These are all things that now that you're out of the day-to-day, you are hyper focused on thinking about and solving. Do you have good employee retention rates? Are you retaining, growing, training them, and making an employee base that is happy and growing? Are you able to close your books within 10 days? And do you have KPIs so that you can see every department, but also that every head of a department and sometimes every person in that department knows exactly how they're tracking to the global growth plan and to their department growth plan and for them personally? I would put forward that Nathan is an amazing person to chat with to solve all of these things. I'm an investment banker. I come in, I can tell you the things that will increase your value, that will decrease your value, and what you got to fix. And there are so many absolutely exceptional people in this acquisition network that really can help you understand how to get independent in your, how to build a sales team, and what is a KPI,
Yeah,
right?
exactly.
If you, anybody listening to this, wants to talk on the technical side or wants to ask more about why does this matter to a buyer specifically, or why is this more important when I'm selling than when I'm just running my business, I would love to chat with you.
Yeah. Well, and I know for a fact, and thank you so much, John, for sharing, just your overall high level viewpoint of what you've been through so far. Can you share with us maybe one case study where you have experienced into like let's just say one company that has implemented proper procedures inside and then what it did to their overall valuation upon the exit, and then also one company where you saw that they came to you and they didn't have a professionalized organization.
Yeah. I mean, we had one that was a very, very large company. You would be shocked. And they were very good at running the business, not so much at accounting. And in their case, they were literally running $80 million a year through an Access database. um, Nobody even believes when I say that, but they couldn't tell the difference between a quote and an invoice. And when we asked, how do you know? We were told the office lady knows all of that. She manages it all. And that was the craziest thing I've ever heard because getting to $80 million at that is already amazing. We came in and there was no way to validate the financials. So we spent about 8 months rebuilding 5 years of financials, thousands of transactions for an $80 million gigantic construction company. um, $80 million. It's I'm not saying the specific industry in all of this, but you're talking about a few $100 million transaction because of how incredibly profitable they were and the industry they were in. And so after converting all of that, we were able to get through a quality of earnings. We cleaned up the books so well that the CPA firm that did the quality of earnings didn't actually know there had been a problem. And we got through diligence on the buyer that made the offer. We checked through accounting diligence in 30 days. You would have thought a year before there was no way we're going to get it through an accounting diligence. We did it faster than ever because we rebuilt it. We made it kind of flawless there, right? The whole time we were working on that, they were working with an advisor who was helping them make sure to document all their processes, the training. Short story, we get into the deal, we get done with all the technical diligence, and they start asking the owner questions. And the owner starts to roll out all of these conceptual things he built in his business that show why they don't have as much receivables, why they built the business this way. And the buyer, private equity's jaw was on the floor because this guy was a brilliant businessman who you never would have known if they were arguing about journal entries the whole time. You never would have found out. This guy is actually like a savant at
Hmm.
business. And in one of the most rare scenarios ever, the price of the company went up by $20 million over the course of diligence,
Hmm.
which is
Interesting.
bananas, right? So when you are handing them over a company that can be just run and added to, that's the highest value. We just sold a company where we hold the record for the highest multiple in an industry at an EBITDA level, right? It's a little specific, but we're very proud of holding the record. And primarily the reason was these guys, they were in Vistage, they were in a number of groups, and they every single week for the 10 years of their business, they fixed something, right? They made it almost that this was like an addiction they had. It was crazy. It was like, why did you have the forethought to think to automate the invoice process when you were a 2-year-old little company? But they had automated it. They implemented an ERP. They had a CRM. Everything had to talk to each other. They were in a construction industry, so their safety meetings were done exactly this way. Like they had literally camera systems with AI to make sure someone wasn't on their phone. Like they had eliminated everything as a tiny business. And so by the time they grew big, they had this perfect handle on it. So when we sold the business, the parting comments from the buyers were, man, we really went to the last dollar because we're going to start tomorrow. We buy this, and we already know we're going to go out and buy 100 trucks, and this company is going to double by the end of the year. So we lowered that risk, that real risk and that perceived risk so low by having everything measured that they believed they could give all of the money they were capable of giving and still be able to make a return. So
Hmm.
be that company.
Yeah, be that company. What is, a lasting word of wisdom that you would give to the operators out there that are running that $2 to $50 million company? And, I know that we've seen it time and time again, both you and me now through a lot of interviews of people, but it just seems as if individuals aren't as proactive. But I'd ask what words of wisdom that you would give to those people, in summary of what they should do in order to, increase that value and initially just exit.
Yeah, I mean, I would say right away, start looking at these top seven things. These are the things you really need to do. Reach out to you, right? And get an advisor to just do kind of, it doesn't have to be a big thing. You can talk to us, we can make you a roadmap. Here are all the things that you do well, and here's what you're valued at today. And then here are those kind of 3 to 5 things that if you fixed over the next 1, 2, 3, 4, 5 years, that you could have a huge impact. And then
Yeah,
if you have a 5 year horizon, man, do you have a lot of time to remodel processes and even entity structure. You might decide to go a C Corp and get qualified small business stock, right? When you have this long time horizon, you really need to think about exit 5 years early, and you really need to start going 100% at it with a full team 1 to 2 years before you go to market.
that's good. So having a long-term thought process and just being a little bit more proactive is going to help you and your business to professionalize, in essence, your organization, because nobody will want to buy your company if they do not see any of your systems that have been professionalized, just like what John has been saying today. So thank you so much, John, for being a part of the organization of the acquisition headquarters, as well as just giving, generously of your knowledge and time here. Make sure to also look up John at Harborstone Group and book a consultation with him with your investment banking needs as well as your potential buy or sell of a company. I mean, just the other day I called John and I had somebody within our network who said, "Hey, we're looking for 6 million in potential debt or equity, and we want to be pretty creative with our capital stack." And it turned out really, really well. As far as just the potential that we had there, as well as some introductions that were made. So that's really the power of the relationships. It's really the power of knowledge and, just being able to work together with each other, which is why we've created the Acquisition HQ network here. As far as the value that we're going to continue to provide for everyone out there is we have access to our web app community. We've got our community director, Maxie, who helps to curate strategic introductions for individuals who are wanting to meet others within the network. Then you also receive free entry into all of our acquisition headquarter council meetings at every one of the states that we're expanding into, which would be Salt Lake City, San Diego, Austin, and Nashville in 2026. So we're excited about that. And that actually becoming a member of the AHQ network will give you a VIP ticket to the upcoming conference, which is valued at $12.95. This is just a screenshot of our current tech stack. This is everything that you do receive. Again, it's 3K per year per person, and you do receive full access to all live recorded workshops. You have access to all of our YouTube channel, access to our private community, access to all of our national pop-ups, access to all of the individuals that are within our network, access to our deal flow chat thread, access to the conference tickets, and a bunch of other things that we're launching. Non-members do receive access to the online education on a bi-weekly and then our YouTube, but nothing else. Again, we're excited to be able to launch our national conference again, Acquisition Conference in Salt Lake City on March 5th and 6th. Make sure to grab your ticket. We will cut it off at 300 individuals in the room. Our room is very curated where we have the right people in the right seats around circle tables to where you guys can network, that you can solve problems and create deeper relationships that in essence will, one, increase the speed of your deal, and it also increases your trust as well. Feel free to contact us. This is our website, acquisitionhq.co. And then if you are interested in applying for membership, feel free just to go to acquisitionhq.co/network. We just want to say again, thank you so much for joining us today for our presentation of how to build a valuable business and all of the various metrics that it takes in order for you to do so. We do again say thank you, John. Thank you for everyone who has joined us, and make sure to reach out to John if you do have any further questions. And until next time, we will have our next educational meeting in 2 weeks from now. In addition to that, if you are in the Salt Lake area or you would like to fly out to Salt Lake in January on the 23rd to celebrate our city council launch, or if you're in Salt Lake City or sorry, San Diego on January 30th, we'll be launching our AHQ council there during the January 30th, which is the date. So again, thank you so much for joining us. We look forward to connecting.